Hello, this is Dale. I've been a trader for over 35 plus years. This is how I've made my living. I am also the founder of what I believe is the best option education website available today, and that is www.optionsinfinity.com. What we do at Options Infinity is we focus on showing mentees how to profitably trade credit spreads, both weeklies, monthlies, and leap credit spreads. I believe this is the very best way to earn a consistent monthly income. There will be some losers, there will be some losing streaks, but in the long run, you're going to see a consistent monthly profit. What I'm going to show you in this video is 3 separate cases where I'm going to actually compare putting on a vertical spread, either a bull put or a bear call, and at the same time putting on either a call or a put, a straight call or a put, and comparing how those perform. The first one, what we have is Johnson & Johnson, and up above you can see the chart of Johnson & Johnson, and this trade was made from May 13 through June 26 of 2020. And what we had was a slight move down. Now, focusing on this chart, I usually look at the regression channel, and the black line is the regression line. The green is the plus or minus 1 standard deviation. The gold is the plus or minus 2 standard deviations. Statistically, 95% of all prices will be contained within this channel. I think this is a great tool to see when you can start to be bullish and when you can start to be bearish. And if you look at the chart right around here, when we were between the +1 and the +2, that's time to start looking for a bearish opportunity. Well, J&J did drop down, and actually it made a measured move right here. Now, I have a lot of videos on my video channel. At the end, you'll have an opportunity to subscribe to that channel that will fully explain the regression channel, measured moves, Fibonacci's, all the tools, and there's only 4 that I use to trade. At this point in time, it did make a measured move, and we entered right here. And what I did is I entered with 18 September 175, 165 call. What we did is we sold the 165 and bought the 175 for protection. You can see the channel for that right up here. So we are out of the money. We're selling out of the money and then buying one further out of the money for protection. The cost on that was $1.07, and that was actually a credit. It goes into our account, $1.07. Simultaneously, we could have bought a put because the thinking was this was a bearish situation. And if we bought an at the money put, it would have been the September 145 put at $8.85. Now, the price immediately reverted back up to 0.2, and then it kind of traded down and meandered along, and I'm taking a look at 0.3, and then finally it did drop, and it dropped down to the 127 on the Fibonacci, and this is where we exited. So at 0.2, the trade had gone against us. You can see that the bear call that we had dropped 11.21%. If you had a straight put, you would have been down almost 25%. Then the price kind of meandered around, but it did drop a little bit. And at 0.3, the bear call would have earned you 44%, whereas the put is still in negative territory at a minus 28%. We did have quite a drop here at the end, and this is where we exited on 0.4. And 0.4, we let the bear call expire worthless, so we gained 100% versus a straight put, which did indeed increase in price, and you could have gained 35.8%. So here, a bear call was a lot more valuable than a straight put. And that was for a slight move down. Now on the next slide, what I'm going to show you is the SPX Weekly. And this was a very quick drop. We got in right here as the SPX Weekly was channeling. Here's the ceiling, here's the floor, here's the ceiling, here's the floor, here's the ceiling. It finally broke through. 0.1 is where we got in, and this was also with a bear call and comparing that to just a straight put. 0.1 is where we got in. 0.2, it actually had dropped down in our favor, but then came back up to the ceiling. And we'll take a look at what the value was at 0.2. And then ultimately we got out once it had a major drop down at 0.3. The entry was on June 19th of 2020. What we did is we sold a bear call the 26th June, selling the 3200 and buying the 3205 for protection. For that, we got 95 cents worth of credit. Simultaneously, if we would have bought a put at the 26th June, 3140 at the money put, we would have had to have paid $62.75. Now the price went down, but then came back up, and at 0.2, our bear call was even, just even. Whereas the straight put would have lost this 40% because of the time that we had lost here. Now, finally, we did have quite a move down here to 0.3. In our bear call, we got out with about a dime left here for a profit of 89%. The put, even though it was a tremendous drop, only had gained 33%. So once again, the bear call or the vertical spread, the bearish bear call, performed better than the straight put. One of the nice things about vertical spreads is time is in your favor because we are a seller. We are a seller, and then we buy one further out of the money for protection. The final slide I want to show you is for McDonald's, and this was a trade that went against us. We got in here at 0.1. You can see it went up. We had a bull put here. We were looking for the price to go up, and it started to go up. So we're going to compare 0.2, and then it dropped and went against us. And this is when we finally exited at this point here, 0.3. So let's take a look at how the bull put versus the straight call performed. On June 3rd, we bought a 21 August where we sold the 175 and bought the 165 for protection. Got a credit of $1.41. Simultaneously buying a call, the 21 August 190 at the money call was $11.25. When the price had been going with us, we were making money on both the bull put and the bear call. You can see they were almost equal. Then it reverted back and we were down here. This is about where we got in, and we were lower than that on 0.3. We decided to exit, and both the bull put and the straight call had a negative number, but neither one had an advantage. In all three of these cases, I think you can see that the vertical spread allows you a more conservative trade. You can be profitable if the trade goes in the direction you're looking, if it goes sideways, or if it goes actually against the move you're looking, but only a little bit. And then time is in our favor. If with a straight call and a put, you have to have the direction correct, you have to have the timing correct, because time is working against you. This is just three examples of a myriad of examples I could show you on how vertical spreads outperform straight calls and puts. This last chart, what I want to show you is the equity curve for trades that I release through the website www.optionsinfinity.com. This is from all of 2019 and all the way up till June of 2020. And you can see that this is a very positive equity curve. There are some losses, there are some losing streaks, but the equity curve is positive for the 1.5 years that I'm presenting here. We've been in business for 10 years without a losing year yet. Now, what I'd like you to do is you'll see on your screen, a circle, a green circle with a D in it. That if you click on that, you can subscribe to my YouTube channel and have access to, I have over 27 videos in there explaining how I trade, things about financially strong stocks, the advantage of verticals versus calls and puts. There's a lot of different topics in there I think you're going to find educational. Also on the right-hand side, you'll see a thumbnail, and if you click on that thumbnail, it will take you into the first video of a 12-part series where I show you exactly how I trade. I hope you join me. Bye-bye now.